Firstly, thank you, Curate. Thank you, the Curate team. It is truly an honor and a privilege to be here tonight, today, and also to be in your company and among some of our peers. So, by way of background, before I get going, the company is 21 years old. There's a slide at the back. We started as hedge funds. We were maybe the third or fourth hedge fund in '98. I started the company in 2003. And it's important to state that our background was long only. I came from Liberty Asset Management in the days of Donald Gordon and Roy McAlpine, Roy Anderson. So, and Liberty was always known for its fundamental research, its deep knowledge of companies. And from there, we stepped into hedge funds back in the early 2000s. So Visio is 2003, is 21 years old. And there are some differentiating key points that I think I'd like to highlight and makes us potentially a little bit different to some of our peers. There's a slide over here which talks about our general engagement with companies. Now, it's not general in the sense that we go and we talk to them and have a nice conversation, but where we see value, we will engage. We will engage constructively. We will not piss off the board and the management, but we will actually look to unlock value, ensure that interests are aligned. The interests between the management, the board are representing shareholders, and to ensure that the shareholders, which are our funds, our clients, their interests are being taken care of by the board. This is a list that only goes back to 2015. Some names are missing. There are one or two that may be close to home. But essentially, we've been doing this since 2003. I was in the newspapers in 2003 when Christo Wiese took out Pepco for what was then 2 billion rand. 2 billion rand translates now to about 150 billion if you add up everything that Pepco was or could have been, if not for Steinhoff. So we fought back then already for the takeout of Pepco. Pepco was then 7% of our funds back then. So where we see opportunity, we will concentrate our funds, our portfolios. So this just gives you a sense of the engagement that we take. We don't make a big noise. We're not in the newspapers. We will do it constructively. We will gauge the willingness of the board and management to look to unlock value, or in some instances appoint the right directors. In other instances, remove certain directors, focus on capital allocation. It could be simple things like change the name of the company to something that makes more sense. So I'll give you an example of one called Advotech. There's three instances here, but it's actually, there's one more, a more recent one. But essentially, a company we've been invested in for 20 years in the funds. This just gives you a little bit of an example. When things started going sour, early 17, 16, we started sensing that the capital allocation was remiss of certain disciplines. So we started engaging in 2018, and disclosure, etc., were some of the points. And we carried on. We've actually built a good rapport with the company over so many years. And it got to the point where in 2021, we actually brought in other shareholders, Value Capital, as activists, or kind of sat on the board and almost looked after our investment. We don't like to take board positions. We got Adam Gray to sell down. We got Coronation to sell down. We sold down. We got VCP in for 6%. And proof is in the pudding. This is what Advotech has done since 2014. If you go back further, you'll see a compounding return of 14% a year. So even in hedge funds, you can hold on to good companies for a decade or 2 decades. In this instance, relative to the all share, you can see what the company's done. Now, this discipline very much permeates across the way we manage our funds. In the Curate Balance Fund, it will once again be the same disciplines that we apply, and essentially that's how Momentum has known us to manage funds. We follow a very disciplined approach in the balance funds, which is a beautiful vehicle to have because it aggregates what we do in the long onlys, what we do in the hedge funds, what we do with our fixed income team headed by Johnny Myerson, who's a brilliant fixed income and a bit of a legend or a doyen of the industry. And thankfully, through all that, this experience, we aggregate all of that in the balance fund. Like our other peers, it's a concentrated portfolio. We have about 30 equity positions. We follow a pretty disciplined approach in the way in which we construct the portfolio. And the next slide just depicts the makeup of the portfolio currently. The nice thing with the balance fund is you can shift direction a little bit. We shifted direction a little bit before the GNU. We thought the downside was quite limited, and then we increased it post GNU. We added a bit more domestic exposure. Domestic exposure means reducing even local shares that have rand hedge characteristics and buying more property, for example. We bought a bit more banks, etc. That's the beauty of a balanced fund. We shifted the fixed income portfolio a little bit, also. And again, that just talks to the flexibility we have. We're a boutique fund manager. We run about 30 billion rand. We can move quite quickly. We are not limited in terms of our ability to make decisions quickly. The next slide just gives you further ideas to the companies that we like. Many of these will be familiar to you. I think some of the interesting ones are what's in special opportunities. We actually have a letter for Johan Rupert, for Reinet. We haven't sent it yet. It takes a lot of balls to send Johan a letter and to kind of question or debate with him what he's doing within Reinet. Reinet is a beautiful vehicle. It holds 49% of Pensions Corp in the UK that is very involved in the pensions risk transfer that is happening in the UK. We've been investing in Reinet for the last 2.5 years. We very much like this theme of moving defined benefit plans off corporate balance sheets in the UK onto writers of annuities. It's happening in the US in a big way. It's happening in the UK. Reinet has given us about a 35% return plus dividends in 18 months. Momentum, we like. SAPI, another special opportunity with some great breakup value. So again, we are engaging with the board. We are doing it constructively. We're not wanting to upset them all. In essence, it's ensuring interests are aligned. One other interesting one is Alexander Forbes, another one where we are one of the last remaining shareholders. We've been invested for about 4 or 5 years. Dawie de Villiers has done a pretty good job there, but essentially, it's a business that is generating huge amounts of cash. It has 2 remaining shareholders, ourselves being one. It's essentially a company that at some point will delist. So these are the types of things as a hedge fund manager, you see the opportunity, you engage, you sit with a position, we're not bound by the index. And the balance fund had 8% in Alexander Forbes until we sold some to the biggest shareholder. He keeps nagging for shares. So we're in good company. From our offshore exposure perspective, we're not going to profess to be rocket scientists or to be better than anybody else because it's a pretty big market out there. But we do focus on themes. We break down our opportunity set across themes we believe are relevant for the medium to long term. The important ones, obviously, are all those that are touching the increased urbanization around the world, the emerging different forms of spending, and it's just incredible the opportunities that we can touch. I actually listened to the last week's Amazon's results this morning at gym, and it's a company we've been invested in for a number of years now in our offshore funds, in our hedge funds, in our balance, in our flexible mandates. It's just an incredible, the infrastructure they've put down that is pervasive, that will continue to grow, generating huge amounts of cash now. And similar to something like a Microsoft from a digital age and with this whole open AI, etc. But I think you must look at a Microsoft almost like a utility. A utility is something you use on a daily basis. It's kind of a necessity. I think right now Microsoft very much fits the bill of a utility. We use something of Microsoft every day. We pay a subscription every month. It's almost a hidden sunk cost. And it's close on 2 billion people that are on the Microsoft 365 and Windows, Excel, etc. So just some examples. We don't try and reinvent the wheel. There will be some things that are interesting. We invested in GE Vernova as it got unbundled out of GE. We just know the incredible demand for electricity and decarbonization and taking away coal-fired power stations towards gas and towards other forms of electricity, even nuclear. GE really fits that bill. So, and then Novo Nordisk, you would know, is around obesity. So simple themes, and this is how we populate the offshore portfolio. As I mentioned earlier, Visio is 21 years old since July this year. We have 15 investment professionals. 68% of the portfolio of the shares are held by the staff. We have 2 strategic shareholders. We have we have presence in London, Tel Aviv, Sydney, Cape Town, where your fixed income team is, and Johannesburg. And we've got roughly 30 billion under management. And we enjoy what we're doing. We're very focused. We don't make a big noise. And we are very excited about the opportunity to do justice to the Curate Balance Fund. Again, thank you very much. I've been told I must put in those are some of the key members. You'll meet Jonathan. He'll come up just now. And I just need to remind you that there's a disclaimer. So we are absolved from anything that we say in case it doesn't work out. I don't know where the disclaimer's gone.